So, how does credit card interest actually work? Most people just see APR on their statement and move on. But here's the truth. Interest on a credit card is calculated in a very specific way. And once you see how it works, it makes a lot more sense why balances can grow so quickly. Let's break it down. First, every credit card has an APR, or annual percentage rate. Think of that as the yearly cost of borrowing money on the card, but the bank doesn't wait until the end of the year to charge you. Instead, they take that APR and break it into a daily periodic rate. Basically, the APR divided by 365. So if your card has a 20% APR, they divide that by 365, and you're left with a daily rate of about 0.055%. Doesn't sound like much, right? But here's where it matters. Every day you carry a balance, the bank multiplies that daily rate by your balance. That amount is added on top, and then tomorrow they do it again and again. That's called daily compounding, and it's why balances can creep up much faster than people expect. Now here's where people get confused. The difference between your statement balance and your current balance. Your statement balance is the total you owed at the end of your last billing cycle. That's the number you need to pay by the due date to avoid interest. Your current balance, though, is everything you've spent since then, plus the statement balance. It updates every time you swipe your card. So here's the key. You only need to pay the statement balance by the due date to avoid interest. You don't have to pay the entire current balance unless you just want a zero balance. Paying the statement balance is what resets the clock and keeps your purchases interest-free. But if you pay less than that, say just the minimum payment, the bank starts charging interest on the unpaid portion. And from that point forward, it compounds daily. Let's make this real with an example. Imagine you borrowed $100 on a card with a 20% APR. That daily rate of 0.055% works out to about 5 cents in interest the first day. The next day, you're paying interest not just on the $100, but also on the $100.05. Then, the day after that, it's on the slightly higher balance. Over a year, that $100 turns into $122.13 instead of the flat $120 because of the daily compounding if you never made a payment. And that's with only $100. Imagine it with 1,000 or 10,000. And one last detail. Even if you pay your card off in the middle of a cycle, you might still see a small leftover charge on your next statement. That's called residual interest, just the daily interest that built up between when your last statement closed and when your payment posted. It's not a mistake. It's just how the math works. So to recap, the bank takes your APR and turns it into a daily rate. They apply it to your balance every single day. Paying your statement balance on time keeps you interest-free. Paying less means daily compounding starts building fast, even on small amounts. And here's the good news. If you stay on top of it and avoid interest, you get to enjoy the full upside of using a credit card, building your credit, earning points and miles, and tapping into rewards that can pay for flights, hotels, and more. That's when credit cards stop being a burden and start becoming a tool that works entirely in your favor. If that explanation made credit card interest finally click for you, do me a favor, hit like, drop a comment, and subscribe for more practical money breakdowns just like this.